Usually when we talk about a medical diagnosis, there's this strict expectation of precision, you know? It feels almost like engineering.
Oh, absolutely. Like a simple binary.
Right. You break your arm, the x-ray shows this jagged white line on a black background, and the doctor just points to it. Broken or not broken. It's clean, it's binary, and frankly, it's really comforting. We like our problems to be highly visible.
We want things easily categorized, yeah.
Exactly. But if you step into the world of, say, neurodevelopment or complex autoimmune diseases, suddenly that x-ray machine is just completely useless.
Right, the whole diagnostic landscape becomes incredibly murky.
Very murky. You're reliant on behavioral observations over a long period of time. And it's highly dependent on the actual skill of the specialist who's, interpreting those symptoms.
It forces you to completely abandon the comfort of a single snapshot. You have to start looking at long-term trajectories because you're evaluating a system that is constantly moving.
Yes, exactly. And it turns out that exact same psychological shift is required when you move from the public stock market into the world of private investing.
Oh, without a doubt, it's a huge shift.
Because we are so conditioned to the clean, highly regulated, totally visible world of daily stock tickers, right? We want that financial x-ray.
But in private markets, that x-ray machine is completely unplugged.
Unplugged and locked away. So welcome to another deep dive. Our mission today is to decode the really exclusive, opaque, and honestly highly complex world of private markets.
And we are using the rigorous framework of the Schweizer Notes 2025 Level 3 CFA Private Markets curriculum to do it.
Specifically focusing a lot on the mechanics laid out in Reading M2 and the surrounding modules because, we really need a roadmap for this.
We do. It's an essential framework because the financial media tends to just mythologize private market.
Oh, totally. It's always about the billionaire founders.
Right. You hear about these legendary venture capital returns or massive corporate buyouts, and it sounds almost like alchemy. But this curriculum strips away all that mythology.
It really forces us to look at the mechanical realities, right? The structural constraints, the math, the trade-offs you have to accept to actually execute these investments.
Exactly.
So whether you are managing a massive institutional portfolio or, maybe you're studying for one of the most brutal finance exams on the planet.
It really is brutal.
Or maybe you just want to know how the ultra-wealthy and these major institutions deploy trillions of dollars behind closed doors. Well, we are going deep today.
There's a lot of ground to cover.
There really is. And the sheer scale is what gets me. We are talking about trillion-dollar pension funds happily locking up massive chunks of capital for a decade, watching their early returns go totally negative, all in pursuit of a premium that you cannot find on a Robinhood app.
Well, the thesis underlying all of this capital movement is that private markets offer unique diversification and return potential.
Great.
But they demand incredibly complex due diligence and a massive tolerance for illiquidity. You also need a deep understanding of unique asset life cycles. You simply cannot apply public market logic to private market assets.
Because the foundational plumbing is entirely different.
Completely different.
So let's start with that fundamental plumbing. Before we even look at specific private investments like venture capital or real estate, we have to understand the great divide between the public sandbox and the private sandbox.
The structural differences are huge.
Right. And the best analogy I can really offer is this. Public markets are basically a global supermarket.
Okay, I like that.
The prices are observable, they are clearly labeled on the shelf, the goods are completely standardized, and you can fill your cart and check out anytime you want. But private markets operate more like a high-end, closed-door estate auction.
Yeah, building on that supermarket analogy, the most glaring characteristic of public markets is that open-ended liquidity.
You can just sell whenever.
Right, there are virtually no restrictions on selling your shares of a massive publicly traded tech company. The market absorbs that transaction instantly. But private markets are inherently illiquid.
Which is the estate auction side of it.
Exactly. When you participate in that closed-door estate auction, you're buying a unique, non-standardized asset. And your ability to sell it is heavily, heavily restricted. In many private funds, early redemptions are just completely prohibited for years.
Wow, prohibited.
Yeah, you are structurally locked in. It's a closed-in investment process by design.
Which completely changes the psychology of the investor. It has to. Because in the supermarket, I know exactly what an apple costs today because thousands of people are buying and selling apples every single second.
Right. The clearing price is undisputed.
But in the private world,
In public markets, asset prices are observable and traded continuously, like you said. In private markets, prices are negotiated. They're estimated.
So it's a lot of guesswork.
Well, highly educated guesswork. You're relying on mark-to-model valuations or periodic appraisals. You never actually know what a private asset is worth with absolute certainty until the very day a buyer wires the money and you hand over the keys.
That is wild. And that lack of a daily clearing price means the person managing the money needs a fundamentally different toolkit, don't they?
Oh, absolutely.
Because, I mean, a public fund manager is essentially a very sophisticated passenger. They analyze the company, they read the 10Ks, they model the industry trends, and they bet on the stock.
Right, they sit on the sidelines.
Yeah, they're relying entirely on the company's existing CEO and executive team to actually drive the car and create the value.
Whereas the private manager actually has to get under the hood. Because private fund managers often acquire significant or even controlling stakes in these companies. They need hands-on operational expertise.
They aren't just betting on the driver anymore.
No, they are firing the driver. They're rewriting the legal structure, executing tax optimizations, overhauling the accounting practices, and initiating direct operational restructuring.
So they basically take over the whole company.
Essentially, yes. They control the assets, which means their skill set has to bridge high finance, corporate law, and raw corporate management.
And this brings us to the trillion-dollar question. If private markets require locking up your money for years, abandoning the comfort of a daily stock ticker, and relying on these managers who have to physically rebuild companies, why do it?
Why go through all that trouble?
Yeah. I mean, the capital flows into these markets over the last decade have been staggering. Why are institutions pouring so much money in?
It really comes down to the dispersion of returns and the historical outperformance. Following the global financial crisis, we saw a macro environment of rising valuations and incredibly low interest rates.
Right. Money was basically free.
Exactly. In that specific climate, private markets broadly outperformed public markets. The CFA text highlights some very compelling historical data on this, actually.
What kind of numbers are we talking about?
Well, looking at private equity funds with vintage years from 2009 to 2019 and calculating their performance through late 2022, the median net internal rate of return, the IRR, was 20.1%.
Wow. 20.1%. Meanwhile, the S&P 500 over a similar time frame was averaging somewhere around, 11.8%?
Right around there, yeah.
So the median private equity fund was nearly doubling the public market average. But, and this is a big but, looking at the median hides the most critical danger of private investing, doesn't it?
It does. It hides a massive canyon.
Because in the public market, if you buy an S&P 500 index fund, you are mathematically guaranteed to capture that 11.8% market average. You completely eliminate manager risk.
But in private markets, there is no index fund. You cannot passively buy, the private market.
Right.
This is where the dispersion of returns becomes the defining feature of the asset class. The performance data for those exact same private equity managers spanned a massive range. The top quartile of managers delivered a 29.8% IRR.
Almost 30%. They absolutely crushed the public markets.
They did, but the bottom quartile of those managers only hit 11.4%.
Wait, 11.4. So they actually underperformed the S&P 500.
Exactly.
You locked your money up for a decade, paid these massive fees, took on all this illiquidity risk, and you would have been better off just buying a public index fund on your phone.
Yep. What's fascinating here is that the manager is the alpha. In public markets, asset allocation drives the bulk of your return. But in private markets, manager selection is arguably the single most critical variable.
If you pick a bad manager, you're toast.
Right. If you pick a bottom quartile manager, all those structural advantages of private equity mean absolutely nothing.
So let's look at how these managers actually structure the capital, because it basically dictates the entire life cycle of the investment. We're talking about the limited partnership structure, right?
Yes, the classic LP structure.
You have general partners and limited partners, and the division of power and liability is heavily asymmetrical. Very asymmetrical. The general partner, or GP, is the firm managing the fund. They hold total investment and operational control.
They call the shots.
They decide which companies to buy, how to restructure them, and when to sell them. But in exchange for that absolute control, the GP typically carries unlimited liability.
Oh, wow. Unlimited.
In certain legal contexts, yes. If things go disastrously wrong, they are on the hook.
And then on the other side, you have the limited partners, or LPs. These are the massive pension funds, university endowments, sovereign wealth funds, and high net worth individuals.
They have deep pockets.
Right. They provide the capital, but they surrender all investment control. They cannot call the GP and demand they sell a specific asset.
No, they have no say in the day-to-day.
However, their liability is strictly capped at the amount of capital they committed to the fund. They can't lose more than they put in. Exactly. Now, the curriculum also notes that LPs are not strictly bound to this blind pool fund structure. There are variations. An investor can execute a direct investment, which means bypassing the fund intermediary entirely to purchase a private equity or debt stake on their own.
Which takes a lot of in-house expertise.
It does. Or they can engage in co-investments.
Now, co-investments always seem to me like an LP trying to have their cake and eat it too.
It really is, yeah.
Because you are an LP in a broader fund, but when the GP finds a particularly massive or attractive deal, they might invite you to invest additional capital directly into that specific target company alongside the main fund.
Right. It's a side by side.
And it allows the LP to put more money to work in a high-conviction deal without paying the typical GP management fees on that specific co-invested slice.
It reduces the overall fee burden for the LP significantly. But it dramatically increases their concentration risk.
How so?
Well, if that specific company fails, the LP takes a hit in their main fund portfolio, and they take a total loss on their co-investment piece.
Ouch. Double whammy.
Exactly. But assuming we stick to the traditional LP fund structure, we have to look at the timeline. Public stock purchases settle in a day, but private assets follow a rigid 4-phase investment life cycle that spans years.
Right. Let's walk through those phases. Phase 1 is pre-commitment. This is essentially the capital raising phase, right?
Correct. The GP is pitching their strategy, performing macroeconomic due diligence, and basically asking LPs to sign legally binding commitments.
But no actual money changes hands yet?
None.
Yeah?
The LP is just making a promise to provide capital when the GP eventually finds something to buy.
Which transitions us into phase 2, capital deployment.
Right.
The GP has identified a target company and initiates a capital call, instructing the LPs to wire a specific portion of their committed capital. The GP uses that cash to acquire the asset, and this is where the hard operational restructuring begins.
And this is exactly where the returns go negative.
Yes, the infamous J-curve. We will dig into the mechanics of that in a second, but continuing the life cycle, phase 3 is capital distribution.
The turnaround phase.
Yeah, the restructuring is complete, the target company is generating strong cash flows, the debt is being paid down, and the GP starts distributing cash back to the LPs.
Finally, you reach phase 4, which is the exit.
The payoff.
Exactly. The GP liquidates the asset, either through an initial public offering, a sale to a competitor, or a sale to another private equity firm. And the final proceeds are distributed, formally closing out that specific investment.
Okay, let's back up to phase 2, because this creates a phenomenon that honestly completely short-circuits the brains of people used to public markets.
The J-curve.
The J-curve. Okay, let's unpack this. You're telling me that the most sophisticated institutional investors on the planet wire tens of millions of dollars to a GP and then happily sit back and watch their reported returns plunge below zero for years?
They do, and they understand it is a structural inevitability. The J-curve is driven by the interaction of 3 distinct capital components over time.
Okay, what's the first driver?
The first driver is committed capital. When an LP signs that legal promise to provide, say, $50 million, they cannot just tie that money up in other illiquid, high-yielding investments.
Right, because the GP could call it at any time.
Exactly. They had to keep it liquid and accessible, usually parking it in low-yielding cash equivalents or short-term treasuries, waiting for the GP to call it.
So right out of the gate, you have a massive opportunity cost. Your portfolio's overall yield is being dragged down because a massive chunk of your capital is stuck in a holding pattern.
It is. And the second driver exacerbates the issue. When the GP finally calls that capital, say, $10 million of the $50 million, and deploys it to buy a company, they instantly begin charging management fees on that deployed capital.
Naturally.
Furthermore, the first few years of owning a company require heavy spending. The GP is paying consultants, funding severance packages to replace management, upgrading technology.
So you have capital flowing out of the LP's account, hefty management fees being assessed, and significant operational costs being absorbed by the target company, all before the restructuring has time to generate a single dollar of new profit.
Exactly. If you plot this on a graph, the line of returns drops sharply into negative territory. It forms the bottom hook of the letter J.
It just dives. So how does it recover?
The turning point relies entirely on the third driver, returns distributed. If the GP's operational overhaul is successful, the company becomes highly profitable. They exit the investment at a massive premium.
And then the cash floods back to the LP.
Right. and the graph shoots violently upward, completing the long stem of the J. But surviving the bottom of that curve requires immense structural patience.
I can imagine if an LP gets cold feet.
If an LP panics during year 3, when returns look abysmal, and tries to sell their partnership stake on the secondary market, they'll take a catastrophic loss.
Wow. So the J-curve really forces a completely different approach to performance measurement. I mean, here's where it gets really interesting. If I'm an LP and cash is flowing in and out unpredictably over a 10-year fund life, how do I actually measure success?
It's notoriously difficult.
Because I can't look at my portfolio in year 4, see a negative return, and compare that to the annual return of the S&P 500. It just feels like comparing apples to oranges. It's a completely meaningless comparison.
It is meaningless. The complex timing of cash flows requires us to move far beyond simple return metrics. The most rudimentary measure is return on investment, or ROI.
Right, which is pretty basic.
You simply take the total cash flows received and divide them by the total cash flows invested. You put in $5 million, you get back $10 million, your ROI is 2.0x. You doubled your money.
But the glaring flaw with ROI is that it is completely blind to time.
Entirely blind.
Doubling your money in 3 years is an elite, market-crushing performance. Doubling your money over 25 years barely keeps pace with inflation. ROI doesn't tell you how hard your money actually worked over time.
Which forces the industry to rely heavily on the internal rate of return, or IRR. IRR accounts for both the magnitude and the exact timing of every single capital call and every distribution.
Right, so it's much more precise.
Mathematically, it is the singular discount rate that forces the net present value of all those messy, uneven cash flows to equal exactly 0. It gives you a single percentage number that feels comparable to an annualized public market return.
And the Schweser text hammers home this massive, often ignored vulnerability inside the IRR calculation. It contains a mathematical fantasy regarding reinvestment.
Oh, the reinvestment assumption is the absolute Achilles heel of IRR.
How does that work?
Well, the math inherently assumes that any interim cash flows returned to the LP during the life of the fund can be immediately reinvested elsewhere at that exact same calculated IRR.
Wait. Really? This is where GPs can really distort reality, isn't it?
Oh, big time.
Imagine a 10-year fund that buys 10 companies. In year 2, they get incredibly lucky on one of the companies and sell it for a massive quick profit. They distribute that cash back to the LPs.
A quick win.
Exactly. Because that massive gain happens so early in the timeline, the IRR calculation might spit out a number like 45%.
And the mathematical assumption underlying that 45% IRR is that the LP can take that early cash distribution, turn around, and instantly find another guaranteed 45% return in the broader market to park it in for the remaining 8 years of the fund.
Which is impossible. You can't just casually find 45% yields lying around. So the IRR dramatically overstates the actual economic reality experienced by the LP.
Exactly. A GP with an early win can heavily market a massive IRR to raise their next fund, even if the rest of their portfolio is completely mediocre.
So because of these structural flaws in IRR, institutional investors require a more robust way to benchmark private funds against public markets, right?
They do. And the ultimate equalizer introduced in the text is the public market equivalent, or PME methodology.
The PME is brilliant because it stops trying to compare percentages and starts comparing alternate realities. It builds a simulation.
It asks the LP a very specific question.
Right, it asks. What would have happened to your wealth if, instead of signing this GP's partnership agreement, you just used those exact same cash flows to trade a public stock index?
The mechanics of the simulation mirror the private fund exactly. When the private equity GP issues a capital call and demands $10 million, the PME simulation takes a virtual $10 million and buys $10 million worth of an index, like the S&P 500 or the Russell 2000.
So you're perfectly matching the outflows.
And you match the inflows. When the GP successfully sells a company and distributes $4 million back to the LP, the PME simulation executes a virtual sale of $4 million worth of shares from that public index position.
Okay, so you track this virtual public portfolio day by day, side by side with the real private fund.
Exactly. And when the private fund finally liquidates in year 10, you calculate the IRR of the virtual public portfolio. Now, you finally have an apples-to-apples comparison.
Because you aren't comparing a 10-year locked fund to a 1-year public return anymore, you are comparing the fund to a public portfolio that experienced the exact same cash flow timing.
Yes, and the text provides a fantastic quantitative example of why this matters so much. They look at a €50 million private equity fund. The fund calculates its own IRR at 11.44%.
Okay.
Over that same 5-year holding period, the broader public market index had a compounded annual return of 9.58%.
So if you stop there, you would logically conclude the private fund beat the public market by roughly 1.8%. A decent premium, but perhaps not enough to justify the illiquidity and high fees.
But the public market's compounded return doesn't account for the uneven timing of the private fund's capital calls.
Ah, right.
When the analyst ran the actual PME simulation investing the virtual cash on the exact days the GP called capital and selling the virtual index on the days the GP distributed cash, the PME IRR of the public index was only 8.41%.
Wow. So the timing of the cash flows completely changed the narrative. The private fund's 11.44% IRR actually outperformed the public market equivalent's 8.41 percentage points by over 3 full percentage points.
It did. The GP's ability to call capital exactly when they needed it, rather than being fully invested on day one, allowed them to dramatically outperform the timing of the public market.
But I assume the PME is only as valid as the index you choose for the simulation, right? I mean, if a GP is running a highly leveraged venture capital fund, buying software startups, running a PME simulation against the S&P 500, which is dominated by massive, mature, mega-cap companies, that's a flawed benchmark.
Oh, deeply flawed. You have to align the PME index with the private fund in terms of growth characteristics, value, sector, and capitalization.
Okay, so while PME provides a robust historical benchmark, LPs also need real-time diagnostics. If you are an LP sitting in year 6 of a 10-year fund, you need to know exactly where your capital is deployed and what it's currently worth.
You need a dashboard.
And the curriculum provides this alphabet soup of multiples that serve as a dashboard for the LP. Let's decode them, starting with PIC, paid-in capital.
PIC is the simplest metric. It is the capital invested divided by the total capital committed.
So if I promise the fund $100 million, and over the last 4 years the GP has called $70 million of it, my PIC is 70%.
Exactly. It tells you how far along we are in the drawdown phase.
What's the operational utility of that for the LP?
The operational utility of PIC for an LP is cash flow planning. If the PIC is 90%, the LP knows the current fund is almost fully deployed. This signals 2 things.
Okay.
First, they don't need to hold as much liquid cash in reserve for future capital calls on this fund. Second, the GP is almost certainly going to start marketing a brand new fund soon, and the LP needs to decide if they want to commit fresh capital to the sequel.
Makes total sense. The next multiple focuses on cold hard cash, DPI, or distributed to paid-in capital.
DPI measures realized liquid returns. It is the cumulative distributions paid out to the LP divided by the total capital the LP has actually paid in so far.
So if the LP has paid in $50 million and the GP has sold a few early assets and returned $20 million in cash, the DPI is 0.40 or 40%.
Exactly. DPI cannot be manipulated by optimistic accounting. It measures cash in the bank.
But DPI ignores the massive portfolio of companies the GP still owns and operates. To measure that paper wealth, we use RVPI, residual value to paid-in capital.
RVPI captures the unrealized net asset value. It takes the current estimated value of all the unsold companies in the fund, relying on those complex mark-to-model valuations, and divides it by the LP's paid-in capital.
So if the GP estimates the remaining assets are worth $80 million and you've paid in $50 million, your RVPI is 1.6x.
Correct.
If you are an LP managing a pension fund, you look at these 2 metrics very differently, don't you? A high RVPI looks great on a quarterly statement, but you cannot mail a paper valuation to a retiree.
You absolutely cannot. You need DPI to actually fund your liabilities.
Great. And when you combine the 2, you get the ultimate scorecard. TVPI, total value to paid-in capital.
TVPI is simply DPI plus RVPI. The cash you've already received plus the paper value of what is left divided by the cash you put in. It tells the LP, for every dollar of capital I have actually given you, what is the total realized and unrealized value you have generated?
Okay, now that we have mapped the structural plumbing, the math, and the metrics, let's look at the actual targets. What are these funds buying?
The fun stuff.
Yeah. First up, private equity, which spans the entire life cycle of a company. The curriculum lays out these neat stages, but is there really a hard line between a mature startup and a new growth company?
Not at all. The curriculum explicitly acknowledges that the boundaries are blurred. There is no universal industry consensus on the exact moment a venture capital target graduates into a growth equity target.
The gray area.
Very gray. A seasoned VC-backed company that has just launched its first commercial product and is generating early revenue could easily be classified by one manager as late-stage VC and by another manager as early-stage growth equity.
Right.
However, the fundamental mandates of the capital provided at each stage are distinct.
Let's start at the most speculative edge, venture capital.
Venture capital is focused on the startup phase. The mandate here is formation and survival. The VC fund is providing equity capital to a company that often has little more than a prototype, a patent, or a compelling business plan.
And the GP is taking minority stakes, right? They aren't buying the whole company, they're buying 10 or 20% of it.
Exactly. And the defining characteristic of VC is a catastrophic rate of failure. The GP expects the vast majority of the companies in the fund to go to zero, relying on one or two massive outlier successes to generate the return for the entire portfolio.
And even before the institutional VC funds arrive, the text highlights the role of angel investors.
Yes, the earliest capital.
These are high net worth individuals, often former founders themselves, who provide the absolute earliest seed capital. They aren't just writing checks, they are providing vital industry contacts and operational mentorship to prevent the founders from making fatal early mistakes.
If the startup survives that perilous early phase and establishes a viable product, it enters the growth equity or GE phase. The risk profile shifts dramatically here.
The company is no longer trying to figure out if their product works. They know it works. They have an established product and a proven large total addressable market.
So the mandate shifts from survival to scale.
Exactly. Growth equity funds provide the capital to build out massive sales teams, expand internationally, and crush competitors.
Like VC, these are typically minority stakes. The company is generating significant revenue, but it is often deeply unprofitable because it is intentionally burning massive amounts of cash to acquire market share as fast as possible.
But eventually, hypergrowth slows down. The market matures. And this is where the heavy hitters of the private market step in. Buyout equity.
Buyout equity, or BO, targets mature, established companies. These companies have predictable cash flows, significant market share, and established brands. But they are targeted because they are underperforming their potential, very often due to what the text defines as agency costs.
Agency costs are fascinating because they represent human failure within a corporate structure. It is the misalignment of incentives.
How so?
You have a publicly traded company where the executive team, the agents, start acting in their own self-interest rather than maximizing value for the shareholders. It's the CEO who stops aggressively innovating because they don't want to risk their massive salary. They build a bloated bureaucracy, they fight for corporate jets and lavish headquarters, and the company slowly stagnates.
And the shareholders are too fragmented to effectively fire the board, so the rot sets in?
Private equity investors use buyout funds to cure that rot. They do not want a minority stake. They require a controlling equity stake. They want absolute authority.
They want the keys.
Right. They will often execute a take-private transaction, offering a premium to buy up all the public shares and completely remove the company from the stock exchange. Once it is private, the GP has total control.
They fire the underperforming executives, slash the bloated bureaucracy, and restructure the operational core of the business away from the punishing, short-term glare of quarterly public earnings calls.
And the mechanism they use to execute these massive takeovers is extreme leverage, hence the leveraged buyout, or LBO. They aren't just using the LP's cash, they are borrowing massive sums of money to buy the company, and they are using the target company's own assets and cash flows as the collateral for that debt.
It is a highly aggressive capital structure. The debt used in an LBO is not standardized public corporate debt. The GP negotiates bespoke, long-term financing packages that replace the target company's existing debt structure.
Which often triggers change of control clauses, right?
Yes, those clauses are designed to protect the original bondholders from suddenly finding themselves holding debt in a highly leveraged, PE-owned entity.
The GP spends 5 years fixing the agency costs, paying down the debt with the company's cash flows, and boosting the margins. But the J-curve demands an exit. They have to return capital to the LPs.
If we connect this to the bigger picture, the exit strategy is the final variable that determines the success of the buyout. The GP can take the company public again via an IPO, they can liquidate it, or they can execute a private sale.
And a private sale generally involves two types of buyers, a financial buyer or a strategic buyer.
Exactly. A financial buyer is just another private equity firm. They look at the math, they assess the cash flows, and they offer a price based purely on the standalone financial return they can generate.
But a strategic buyer is a company that actually operates in the same industry. And the text notes that strategic buyers almost always pay a higher premium than financial buyers.
The premium is driven by synergies. If a massive global software conglomerate buys a smaller, specialized software company from a PE firm, the conglomerate isn't just buying the standalone cash flows.
What else are they buying?
They are buying the ability to fire the smaller company's entire HR, legal, and accounting departments, because the conglomerate already has those. They can instantly fold the new software into their existing global sales pipeline, immediately accelerating revenue.
Oh, wow.
Because the strategic buyer can extract these operational and revenue synergies, the asset is literally worth more to them than it is to a purely financial buyer.
The scale of these leveraged buyouts is staggering, which raises a logistical question. If a PE firm is using mountains of debt to acquire these companies, someone has to actually lend them that money. The traditional banking sector has heavily retreated from this space due to regulations. This vacuum created the private debt market.
The private debt market has scaled massively to fill that void. Private debt encompasses loans and bonds used by private companies, real estate developers, and infrastructure projects to raise capital outside the traditional banking system or public bond markets.
Let's contrast private debt with public corporate bonds because the risk profiles are completely inverted. Public corporate bonds are typically issued by massive, mature, investment-grade companies. Because those companies are so stable, the bonds are usually unsecured.
Right. The lender is essentially trusting the overall financial health of the corporation.
Private debt issuers are smaller, younger, and highly leveraged. They are almost universally non-investment grade and, in many cases, entirely unrated by major credit agencies.
Because the inherent credit risk is so elevated, private debt is almost always secured. The lender requires a direct, legal claim on specific hard assets, machinery, real estate, or intellectual property, so they have a clear path to recovery if the company defaults.
And the legal agreements, the covenants, are highly customized. A public bond has standard boilerplate covenants. A private debt agreement is heavily negotiated and contains untested, highly restrictive covenants designed to give the lender extreme visibility and control over the borrower's actions.
The lender might demand prepayment options, or they might embed equity conversion rights to boost returns. We will lend you this money at a 10% interest rate, but if your enterprise value doubles, we have the right to convert a portion of our debt into common equity and participate in the windfall.
The curriculum segments private debt into several distinct strategies. You have direct lending, where non-bank entities like specialized private credit funds originate loans directly to middle-market companies.
You also have venture debt, which is a highly specialized niche, providing debt to early-stage startups that are still burning cash, which carries a massive default risk, but is often paired with warrants for company stock.
And you have leveraged loans, which are typically senior secured, floating rate loans that form the primary debt engine for those massive buyout transactions we discussed earlier.
Exactly.
But my favorite segment of the capital structure is mezzanine debt. If you map out a company's capital stack, mezzanine debt is like the middle child sitting right between the senior debt and the common equity.
The middle child analogy is perfectly accurate.
Yeah.
At the very top of the capital structure, you have senior debt. These lenders take the least risk. If the company goes bankrupt, the senior lenders have the first legal claim on the assets. They get paid back before anyone else sees a dime.
And at the bottom.
At the very bottom of the structure, you have common equity. The equity holders own the upside, but in a bankruptcy, they are the last in line and typically get completely wiped out. Mezzanine debt sits directly between the two.
It is subordinated to the senior debt, meaning mezzanine lenders have to wait for the senior lenders to be made completely whole before they can recover anything. But it sits above the equity.
Because of that subordinated positioning, the risk of a total loss in a default is significantly higher than senior debt. Therefore, mezzanine lenders demand a much higher total return.
They typically achieve this by blending a high cash interest rate with equity kickers, like warrants, ensuring they get a piece of the upside to compensate for the subordinated risk.
But the machinery of private markets doesn't always run smoothly. Macroeconomic environments shift, interest rates spike, supply chains break. Suddenly, a highly leveraged company cannot meet its debt obligations. They are staring down the barrel of a default.
Traditional lenders panic and want out.
And this is where the paramedics of the private market arrive. Special situations funds.
Special situations is one of the most complex and fascinating corners of the market. These funds focus on event-driven, stressed, or fully distressed opportunities. And the curriculum notes a staggering projection. Distressed and special situations strategies are expected to grow to nearly half of the entire private debt market by 2027.
Half the market is preparing to feast on distress. So how does a special situations manager actually generate a return by buying the debt of a dying company? The text breaks down their strategy into exploiting three specific types of risk.
The first pillar is credit risk.
When a company announces severe distress, the public markets tend to overreact. The price of their debt plummets. A special situations manager uses highly sophisticated structural models. The text specifically references the Merton model to evaluate the fundamental reality of the company's balance sheet.
They calculate the true expected losses. If the manager's model indicates that the expected losses are actually lower than the massive discount currently priced into the debt by a panicked market, they step in and buy.
They are identifying a mispricing between the market's fear and the mathematical reality of the assets.
The second pillar relies entirely on other people's structural constraints. Liquidity risk. Imagine a traditional conservative debt fund that is mandated by its own LPs to only hold performing high-grade loans.
Right, they have strict rules.
If a company in their portfolio suddenly defaults, that traditional fund is legally or structurally forced to sell the loan immediately at virtually any price just to get the toxic asset off their books to maintain their mandate.
The special situations manager acts as the ultimate liquidity provider. They know that traditional fund is a forced seller. They step in and buy that distressed loan at a rock-bottom fire sale price.
They aren't necessarily making a bet on the company's long-term survival, are they?
Not always, no.
Yeah.
They are simply buying an asset from a desperate seller at an artificially depressed price, generating a return when the panic subsides and the loan price stabilizes closer to its fundamental value.
But if the company actually crosses the line into formal bankruptcy, the math and the liquidity models take a back seat to the third pillar, legal risk. This is where special situations investing becomes a bare-knuckle brawl.
Bankruptcy is a highly combative legal arena. Different classes of creditors fight over a shrinking pie of assets. Special situations managers have deep, specialized expertise in bankruptcy law and restructuring processes.
They intentionally buy distressed securities to secure a seat at the creditor committee table.
Exactly. They use their legal muscle and procedural knowledge to force favorable recoveries, cram down other creditors, or even convert their debt into a controlling equity stake in the newly reorganized company. They navigate a legal minefield that would destroy a traditional investor.
But the defining constraint of special situations is the clock. We talked earlier about how private equity managers spend months conducting deep operational due diligence before buying a company. If a company is defaulting on a Tuesday and its debt is trading at 30 cents on the dollar, the special situations manager does not have 6 months to study the HR department and review every customer contract.
Time compression is the defining challenge. The due diligence process in special situations is brutally time-constrained. The manager must make massive capital allocation decisions in a matter of days or weeks.
Oh, how do they do it?
Because they cannot perform traditional bottom-up due diligence, they rely heavily on those structural credit models, analyzing market caps, capital structures, and quick leverage ratios like debt to EBITDA to make rapid judgments on highly complex financial dislocations. It is financial triage under extreme pressure.
We have spent a lot of time discussing how private markets fund, restructure, and occasionally dismantle corporate entities. But private markets also build the physical world around us. Let's transition to the tangible assets, real estate and infrastructure.
While the underlying assets are physical, the structural financial mechanisms used to fund them share a lot of DNA with private equity. Let's look at the greenfield real estate life cycle details in the text.
Greenfield means starting from absolute zero, raw, undeveloped land. The life cycle kicks off with the planning, zoning, and land acquisition phase, immediately followed by heavy construction.
For a private fund managing this project, this phase is characterized by massive capital outflows. You are paying architects, buying steel, pouring concrete, and not a single dollar of revenue is coming in. It is a severe physical manifestation of the J-curve.
Once the physical construction is complete, the risk profile fundamentally changes. The property enters the operational phase, the fund begins executing leasing strategies, tenants move in, and the property starts generating steady cash inflows.
The curriculum highlights the specific drivers that dictate the success of this operational phase. The macro location and physical suitability of the asset, the existing supply of competing properties in that specific submarket, and the broader global and regional macroeconomic climate.
The text provides a very grounded example involving a fund called Griffin Co., which is evaluating the development of a network of high-end hotels. It perfectly illustrates how macro and micro factors collide in real estate.
To underwrite that hotel project, the fund manager cannot just look at the cost of concrete. They have to analyze the micro-location, proximity to central business districts, access to major transport links like international airports, and the aesthetic attractiveness of the specific site.
They must also analyze the local supply. How many competing high-end hotel rooms already exist, and is there suitable land for competitors to build more?
And critically, they have to run macroeconomic models, forecasting tourist spending trends, the trajectory of inflation on their construction costs, and the resilience of the project to sudden demand shocks like a localized recession or a global travel freeze.
Real estate is tangible, but infrastructure operates on an entirely different scale. We are talking about the arteries of the global economy. Toll roads, bridges, massive wind farms, telecommunication networks, and regional hospital systems.
These are essential, long-lived, multi-billion-dollar projects, and the text categorizes these investments along an infrastructure risk spectrum that dictates the expected return.
At the lowest end of the risk spectrum, you have core infrastructure. These are fully developed, fully operational assets with an established history of use.
Think of a major functioning toll road connecting two major economic hubs in a stable, developed nation. There is zero construction risk, the usage patterns are highly predictable, and the cash flows are incredibly stable. Because the risk is so low, the expected returns are similarly modest.
Stepping up the risk ladder, we have Core Plus.
Core Plus introduces low-level construction risk. The infrastructure asset is already operating, but it requires modernization, expansion, or repositioning to optimize its cash flows. This is often referred to as brownfield development. You're improving an existing physical footprint rather than pouring new foundations in raw earth.
Taking a larger leap in risk brings us to value add.
Value-add strategies involve significant construction risk. This could be a major brownfield overhaul or a greenfield project in a market where the specific service isn't fully established yet. The fund is taking on the risk that the construction goes over budget or that the eventual demand doesn't meet the initial projections.
And at the absolute peak of the risk spectrum is opportunistic infrastructure.
Opportunistic investments are purely greenfield projects, built from scratch, typically in developing or emerging markets. The fund is layering massive construction and operational risks on top of potentially severe political, regulatory, and currency risks. If the local government changes leadership mid-construction, the entire project could be derailed. The expected returns here must be extraordinarily high to justify that compounding risk profile.
Infrastructure has some deeply unique characteristics that separate it from traditional real estate. One aspect in the text completely upends normal investment logic. So what does this all mean for the physical assets? The text says you might build a toll road and then just give it back to the government for $0.
It is a defining structural feature of many infrastructure deals. These massive projects are rarely purely private endeavors. They are almost always executed in partnership with a public authority or government entity.
The asset is often built on public land.
The private fund enters into a legally binding concession agreement with the government, frequently structured as a build-operate-transfer or BOT framework.
Build, operate, transfer. The fund fronts the capital to build the bridge. They operate the bridge for a strictly defined contractual period, perhaps 30, 40, or 50 years. During that operational window, they collect all the tolls, using that revenue to pay down the massive construction debt and distribute profits to their LPs.
But the critical factor is the transfer. On the exact date the concession contract expires, legal ownership of the physical asset reverts entirely to the granting government authority for zero consideration. The terminal value of the asset, from the perspective of the private fund, is literally zero.
The GP's entire economic model relies on generating sufficient cash flows during that operational window. Because these assets are completely single-use, you cannot retrofit a massive suspension bridge into luxury condos. The economic value of the investment is driven entirely by the enforceability and terms of the concession contract, not by the residual resale value of the concrete and steel.
Because these projects involve massive scale, public authorities, and decades of operational liability, isolating the risk is paramount. A pension fund LP will not invest in a toll road if they can be sued by a driver who gets into an accident, or if the local government tries to seize the fund's other assets to cover municipal debts. The mechanism used to isolate this risk is the special purpose entity, the SPE, or special purpose vehicle, the SPV.
The SPE is a legally distinct, standalone corporate vehicle created solely for the purpose of executing this single infrastructure project. The private fund and its lenders inject all their capital directly into the SPE.
The isolation works in both directions. The LPs are shielded. Their financial exposure is strictly limited to the capital they committed to the SPE. If the bridge collapses, the liabilities stop at the walls of the SPE. They cannot bleed into the pension fund's broader portfolio.
Conversely, the SPE shields the project from the public authority's external financial problems. Furthermore, it allows contractors, suppliers, and operators to sign contracts directly with the SPE, interacting with specialized infrastructure staff who understand complex construction milestones, rather than trying to negotiate with a slow-moving government bureaucracy or a private equity GP sitting in a boardroom 1,000 miles away.
The text notes that these operational infrastructure assets are uniquely, almost perfectly suited for defined benefit pension plans. It comes down to liability matching.
Liability matching is the core mandate of a pension fund. The fund's actuaries know with high statistical certainty exactly how much cash they must pay out to retirees every single month for the next 50 years. Those are their long-dated liabilities. They need assets that generate cash flows to perfectly match those liabilities.
And because infrastructure provides essential, non-discretionary services, the demand is highly inelastic. People might stop buying new iPhones during a recession, but they still turn on their lights, flush their toilets, and drive on the toll roads to get to work.
That inelastic demand translates into highly predictable, inflation-linked, long-term, stable cash flows, allowing the pension fund to perfectly match the income from the toll road to the checks they mail to their retirees.
This raises an important question regarding how these projects actually get paid. The curriculum outlines 3 primary payment frameworks. The most intuitive is usage-based payments.
That is the classic toll road. The fundamental risk rests on the volume of users. If the fund builds a toll road and a new factory opens nearby, causing traffic to double, the fund captures the upside of those extra tolls. If a pandemic hits and everyone works from home, the traffic drops, the revenue drops, and the fund absorbs the loss. The fund bears the demand risk.
But usage-based models do not work for all public goods. You cannot install a toll booth at the entrance of a public high school or an emergency room. This necessitates the second framework, fixed or availability-based payments.
Under this model, the private fund builds the public hospital. As long as the physical facility is properly maintained, fully staffed with facility managers, and legally available for use according to the strict metrics in the contract, the government authority pays the fund a fixed, predetermined monthly fee. It completely divorces the fund's revenue from the actual usage. Whether the hospital treats 10 patients a day or 1,000 patients a day, the fund receives the exact same fixed payment. The government absorbs the demand risk.
The third framework involves regulation-based payments. This occurs when a public authority must regulate a natural monopoly, like a regional water utility, or when the government actively intervenes in the market pricing to guarantee stable revenues for the operator to incentivize construction.
The text provides a fascinating deep dive example of this third model, focusing on a contract for difference, or CFD, used to finance a renewable energy wind farm in the UK. This mechanism beautifully illustrates how governments can eliminate price risk for private capital, but it requires a conceptual shift to understand the math. Let's walk through the mechanics.
The scenario involves a private infrastructure fund that wants to build a wind farm, but the wholesale market price of electricity is too volatile to secure bank financing. To solve this, they enter into a contract for difference with a government-backed entity, the Low Carbon Contracts Company, or LCCC. The wind farm has a defined capacity of 20 megawatts. The critical component of the CFD is the agreement on a fixed strike price, let's say 200 Great British pounds per megawatt hour.
The strike price is essentially a guaranteed baseline. Let's look at what happens when the actual energy market fluctuates. The wind farm generates power and sells it into the open wholesale market. Let's assume there is a massive oversupply of natural gas, and the actual market price of electricity drops to 190 pounds per megawatt hour for a given period.
In a purely free market, the wind farm's revenues would plunge, potentially jeopardizing their ability to pay their massive construction debt. But the contract for difference activates. The market price is 190, but the strike price is 200. The government entity, the LCCC, calculates that 10-pound deficit, and they write a check to the wind farm operator for the difference.
Conceptually, imagine the wind farm's required revenue as a bucket that must hold exactly 200 units of water to pay the debt. The free market only pours in 190 units. The government steps in and tops off the bucket with the missing 10 units. The operator's revenue is perfectly stabilized at the 200-unit mark.
But the CFD is a two-way street. What happens if there is a severe energy crisis? Geopolitical tensions spike, Natural gas pipelines are shut down, and the wholesale market price of electricity rockets up to £300 per megawatt hour.
The wind farm sells their power into the market and collects £300, but the strike price remains anchored at $200. The bucket is overflowing. Under the terms of the CFD, the operator is contractually obligated to pay that £100 surplus back to the government LCCC.
The operator sacrifices all the massive windfall upside to pay for the downside protection. The CFD operates as a pure financial hedge. The revenue volatility linked to the market price of power is entirely eliminated. The cash flows are stabilized, allowing the massive upfront debt to be serviced safely.
But it is crucial to note what the CFD does not hedge. It hedges price, but it does not hedge volume. If the wind stops blowing for a month or the turbines suffer a massive mechanical failure, the farm isn't generating any megawatt hours to sell, so the government isn't topping up any buckets. The operational and volume risk remains squarely on the shoulders of the private fund manager. It is a highly surgical allocation of risk between the public and private sectors.
Which brings us full circle to the core thesis of the Schweizer curriculum. Private markets are not about avoiding risk. They are about dismantling risk, isolating specific components, and pricing them accurately over long time horizons using incredibly bespoke legal and financial structures.
If we pull all the way back and look at the vast landscape we have mapped today, we started by recognizing the Great Divide, abandoning the daily liquidity and observable pricing of the public supermarket for the closed door, operational heavy lifting of the private estate auction. We dissected the anatomy of the fund structure, observing how GPs and LPs navigate the painful, illiquid depths of the J-curve.
We explored the structural mathematical flaws of the industry. We saw how the reinvestment assumptions of IRR can distort reality, requiring LPs to simulate alternate realities using the public market equivalent to find a true benchmark. We decoded the alphabet soup of multiples, PIC, DPI, RVPI, and TVPI to understand exactly how LPs tried the transition from paper wealth to hard cash.
We tracked the evolution of private equity from the chaotic, high-stakes gambles of early-stage venture capital through the massive cash burn of growth equity, culminating in the debt-fueled, agency cost-slashing mechanics of the leveraged buyout. We explored how strategic synergies ultimately dictate the exit valuations.
We examined the shadow banking system of private debt. We saw how highly customized restrictive covenants replaced the standardized public bond market, and we watched special situations managers execute high-speed financial triage, weaponizing credit models and legal expertise in bankruptcy court.
And finally, we looked at how this capital physically builds the world. The macro drivers of greenfield real estate, the vast risk spectrum of infrastructure from core to opportunistic, the vital isolating power of the special purpose entity, and the brilliant risk hedging mechanics of the contract for difference that allows zero terminal value public works to be funded by private capital.
It is a staggering ecosystem of capital, operating on an entirely different set of financial physics than the stock market the public interacts with every day.
And it leaves me with a final provocative thought to ponder. Based on the curriculum's clear data showing the massive historical outperformance and the relentless flow of capital into these opaque vehicles. If private markets keep growing, offering better returns, and capturing companies from startup all the way through maturity, what happens to the everyday public stock market as more and more of the world's real value creation gets locked behind closed doors?
It suggests a profound structural shift in who gets to participate in global economic growth.
Something to carefully consider the next time you look at your own portfolio. Thank you for joining us on this deep dive. Keep questioning the consensus, keep looking beneath the surface, and remember, just because the financial X-ray machine is unplugged doesn't mean you can't learn how to read the murky waters. We'll see you next time.